let's consider the factors that go into determining the price of a single share of Acme Widget Corporation stock. As you can see by the diagram, the height of the stack represents the price of a single share, and this stack is divided into two areas. The bottom hatch portion of the stack is determined by the company's book value, and the top portion we might call the potential profit premium. A company's book value is the same as its net equity, the value of assets minus liabilities. The value of a single share of stock is its net equity divided by the number of shares of Acme Widget Corporation stock outstanding. That is, the number of shares that the corporation has issued. Hypothetically, the price of a share of stock will never fall below its book value per share, even if investors suspected that the company would not be profitable. If the price did fall that far, you could simply buy up all the shares, pay off the debts, and you'd make a profit. In real life, the price of a share of some company's stock might very well fall below its book value if investors think that its prospects are particularly grim. But don't get excited and think that you could profit by dismantling the company. As you started buying up the shares, their price would start to rise. But a company is more than just an inert pile of assets. It is a system of assets that generates a profit for the owners. That's why a firm's shares will usually sell at a premium to its book value. This premium will be determined by how profitable investors expect the company to be in the foreseeable future. The potential profit premium explains why the price of shares will fluctuate every day, all day long, as information and news that investors perceive will affect its profitability become available to the public. If the news is good for the company, like its new product was just approved by the FDA, or its workers decided not to go on strike, or maybe the unemployment rate went down and consumers' incomes went up, the profit premium will be bid up by eager investors. If it's bad news, the profit premium will go down because some of the current owners will want to dump the shares while they can still get a decent price. The book value block accounts for the fact that stocks are real assets, unlike bonds, of course, which are nominal assets. This is why most, but not all, stocks will increase in value when the economy expands and the price level rises, just like those other real assets we've considered, real estate, precious metals, and antiques, and decrease in value when the economy contracts. As we see here, as the economy expands, as measured by the GDP, stock prices, as indicated by the Dow or the S&P 500 or perhaps the NASDAQ Composite, also rise. And as the economy contracts, stock prices fall. But the rise and the fall of the GDP in the stock market are out of phase. In each of the fluctuations below, the major change in the direction of the stock market precedes the major change in the direction of the economy by somewhere between 3 to 9 months. You might want to pause the video at this point and take a close look at this graph because it might be difficult or confusing. I find it so, and I made the thing. At any rate, notice that the GDP is rising and the stock market is rising. But the stock market hits its peak and starts falling prior to the recession here, or the contraction of the GDP. However, before the economy hits bottom, the stock market starts rising again in anticipation of the recovery of the economy. And then, again, before the economy slips back into a recession, the stock market begins to fall. Here you can see that the stock market is going up, way up, even though the economy is contracting. That may seem very odd, but it is doing so in anticipation of this increase in the level of economic activity. And then while the economy is increasing right there, the stock market is falling. That, of course, is in anticipation of this recession here. It would appear to the casual observer that the stock market fluctuates randomly. Obviously, it does not. But even though the economy drives the stock market tends to correctly anticipate future fluctuations in the economy. The problem is that the timing is ambiguous. Now keep in mind that no individual can correctly predict the tops and bottoms in either the economy or the stock market with any degree of consistency. And don't fall for the so-called stock market gurus who will sell you information about which way the stock market will go next. If they really knew, they could just buy low and sell high, or they could sell short when the market was about to tumble and get rich that way. They wouldn't have to try to sell you anything. If there were a key or a formula, they'd keep it to themselves and they wouldn't tell you. Remember this maxim when tempted to succumb to the sales pitch of some self-proclaimed stock market genius. Those who know don't tell. Those who tell don't know. And here is another problem. The economy, as it turns out, doesn't move like this. This is a highly idealized version of the way the economy goes. The economy moves more like this. Look at that last one there, right here. Does that mean the economy is in a long-term upswing, like right here? Or is that just another fluctuation like, say, here, and it's about to go down? There is no way to know. No one knows how high or how deep these fluctuations, short-term fluctuations in the economy will be, but you can believe the stock market will get it right. Here, as the economy is rising, the stock market is rising. However, before it slips into recession, the stock market will fall. Before the economy recovers again, the stock market will rise. Before it slips back into the recession, it will fall. Here it will rise in anticipation of this increase. Here it will fall before the economy tops out. What will it do next? I don't know, and neither does anybody else. But the tendency of the stock market to correctly predict the major changes in the economy is based upon two notions. First, the law of large numbers. That means that incorrect guesses by one investor will be exactly offset by equal and opposite incorrect guesses by another investor. Now, of course, this only happens when there are a lot of investors, and believe me, there are millions and millions of people all over the world participating in U.S. stock markets. Now, there are too many unknown variables and variables that cannot be predicted that determine what stock prices will do. Therefore, it's impossible for any individual to correctly call major turns in the stock market with any degree of consistency, but the market as a whole gets it right. And the second reason for that is that investors base their decisions not only on how they expect the economy to perform, but also on what they think other investors will do. They know, for example, that as the economy gets stronger, profits will rise, causing the demand for stocks to rise, and therefore causing stock prices to go up. So they want to buy before the stock price actually rises. But other investors believe that if some investor will buy prior to the strengthening of the economy, they will buy before those investors do, ad infinitum. Let's look at what we might call categories of stocks. These are stocks that have different attributes that would be important for a range or variety of investment strategies. The first of these are the blue chip stocks. The blue chips in poker are the most expensive ones. The blue chip stocks are the large, mature, stable, high-quality companies that are extremely unlikely to go out of business, Lehman Brothers and General Motors notwithstanding. These are the large cap companies, where large cap refers to their degree of capitalization. That is, their book value or their net equity. Your textbook identifies large cap companies as having a net equity of at least $10 billion. Blue chip stocks are large enough to survive several severe recessions and are therefore of low risk. Many of them have already saturated the world, like Coke and McDonald's and Philip Morris, which is now called the Altria Group, also Microsoft and IBM. Because there isn't much growth potential, most of these returns from the companies will be in the form of dividends rather than capital gains. The income stocks are similar to the blue chips. Most of them are very large, mature, and stable companies. These are the companies that pay out a high proportion of their profits as dividends. As example, Procter & Gamble, Walmart, and AT&T. Growth stocks are small and mid-cap stocks usually. And according to the textbook, a mid-cap stocks have net equities between $2 and $10 billion. Growth stocks are stocks that, because they are smaller, have room to grow. Often, a growth stock will pay no dividend whatsoever. Instead, they plow all of their profits back into the firm so that they can grow larger and fully exploit all of the markets for their products. An investor in a growth stock expects to receive his returns in the form of capital gains rather than dividends. But because they are smaller than the blue chip stocks, they are less able to survive a series of deep recessions, and this makes them more risky. The stock prices of the growth companies are more volatile than are those of the blue chips, and it's also possible, therefore, to make higher returns if the stock price goes up, or it's also possible to lose money if it goes down. In other words, growth stocks have higher risks and higher potential rewards. Speculative stocks are the small and micro-cap stocks. They're usually the startup firms. And even if they're not startups, there are a lot of firms in the energy, mining, or biotech industries that would be considered a speculative stock. It is entirely possible that you could buy one of these stocks for pennies, and then they discover a major vein of gold or copper, or find the cure for some disease, and their stock prices would soar. Even a stock that was once a blue chip but recently fallen on hard times, such companies are known as fallen angels, can be considered a speculative stock. Their stock prices fluctuate even more wildly than the growth stock, so there's the potential for even higher rewards, but at a greater risk. Notice that the last of these on the list is the value stocks. I put this last and in red because I personally believe that this term to be the most insidious in all investing. A value stock, supposedly, is one that is undervalued by the market. But because financial markets are so efficient, you are not likely to find one that is undervalued. Some stocks may appear undervalued to you, but do you really think that the market, consisting of millions and millions of informed investors, will overlook such a deal? A stock price may seem too low to you, but that's because you don't have the same information that the rest of the market has. You can believe that if the stock price seems too low, it's low for a reason, whether you know what that reason is or not. The market knows the reason, and it's the market that's pricing the asset.